Hello everyone, today we're going to talk about trade management. I'm Alexander of Trader Help 101 and you can reach me at traderhelp101@gmail.com. So trade management is one of the most overlooked parts of trading that most traders do, especially beginner traders, because we focus so much on when to enter, when to exit, when to buy. Should I follow this newsletter? Should I follow this news outlet? Which trader should I follow? How to engage with the market. We pay so much attention to that we leave out psychology and trade management. Why is trade management so important? Why is it bigger or more important than when to enter and when to exit? Because once you're in the trade, you don't control how the market moves. You only control when you enter, when you exit, and how much you risk. Once you're in the trade, you have to manage your emotions and you have to manage the trade, hence trade management. And with all the expertise, with all the knowledge of technicals and indicators, traders are about 35 to 45% accurate. Yes, there are traders who are a lot higher and in accuracy, and there are traders who are a lot lower. But that means that with all this knowledge, you're not going to be right often. You're going to be wrong more often. Therefore, risk management is very important. Trade management is very important. Emotional, mental capital, all these are superior to when to enter and when to exit. Most traders lose money in the market. 90% of traders lose money. But that does not mean that 90% of their trades are losing money. This means that once you're in a trade and it's profitable, what do you do? Well, here are a few techniques that you can do. If you're in a profitable trade or in a losing trade, there are two techniques. Technique number one is called the 1-to-1 ratio of trade management. That is, if you have 100 shares and it reaches your profit target, you close all 100 shares and you're done with that trade. Technique number two is you have 100 shares, it reaches your profit target or whatever criteria you use to exit the trade, and you close a portion of the trade. For example, 50 shares. Now you can let 50 shares ride for higher price targets or higher profits. So those are the two techniques. The same thing goes for losses. You have the 1-to-1 technique, which is you have 100 shares, it reaches your maximum risk and you close your 100 shares. And you're done with that trade and you move on. The second technique to also controlling losses once they hit your stop loss is you close 50 shares. Now you have 50 shares open, but the beauty of it is now you reduce the speed at which your losses are occurring. Now from here, the stock can either continue going lower or against you and you lose more money, but you're not losing at the same rate. You're losing at a 50% less rate, which is great. You also took action and you're building accountability following your trading plan. The reason technique number two should be used more often is because most traders have this notion that they get stopped out and then the trade goes for them. When you have any idea in the market, it's always good to back test it, to get data on it. That's super, super important. So if you feel or if you see that a lot of the trades that you're placing are getting stopped out and then they're going for you, we have to understand what percentage is that. Is it 50%, 70%, 20%? You may find out that it is a very low percentage that you're getting stopped out and then the trade goes for you. So always have hard data, hard numbers that you can validate, cross-reference, and then build a strategy around it. That's what trading is about. Trading is about understanding how and when to trade, how and when to use certain indicators. It's not just, hey, if the indicator does this, if the pivot point does that, if it reaches this price point, you enter. It's also the art of trading, and therefore it always pushes back to trade management. That's the art of trading, how you handle profits, how you handle losses. The part of trade management that most do not talk about is how profits affect you mentally and emotionally. How do losses affect you and emotionally? This is part of trade management. Losses and profits are not equal. If you have a huge profit, that's going to affect your account and it's going to affect you emotionally and mentally very different than a small profit. Also understanding where you are in the past of your trading. When you reach these big gains or when you have small gains, how is the overall market? What is the market doing? What are the conditions of the stock? All this information plays a big importance on trade management, because if you're looking to hit a home run, but the market conditions are not there, the stock is not showing that type of criteria, that type of trend or momentum, then you're going to get stuck in a trade and you're going to force the profits onto your account and you're not going to be happy with having a profit at all. You're going to want more. It's not about greed. Once again, it's about trade management. This can also go with fear when you're losing. If you're anticipating a stock to do certain things and you're so focused and you're so biased on the stock going higher, when it goes against you, you may not take the proper action because you're overriding it with all the research, all the homework, all the time that you placed or invested into why the stock should do certain things or why it should go up, that you believe that your research is superior or your confidence is a little bit too much for this trade. So keep everything into content. Trade management is by far superior than anything else. If you have a profit, understand that you're in a position of power. It's now how much am I going to make? If you have a profit of, let's say, $500 and you're anticipating it to go to $700, $800 or more, even if it's $100 and you're anticipating it to go to $150, well, once you're in a position of power, you have to control that. You have to take that because the market's there to take your money. You're competing against the best minds in the world, okay? So once you have a profit, and let's say you have $100 or $200, from there, your position of power is this. I am willing to risk $50 or $100 of this $200 in order to try and participate for bigger gains. That is a position of power. It's very different when you do a trade management, when you have 200 and you don't have that thought and it goes to 200, you're going to feel frustrated. You're going to feel like I should have closed it out at 200. Emotionally and mentally, that's going to impact you very different than scenario number one, where you classified that as a technique, as, hey, I'm going to risk a drawdown. I'm going to risk $50 to $100 in order to participate in bigger gains. Very different. The first one is a position of power. The second one is more of a reactionary, more of like, okay, what am I going to do? Just scrambling at your desk, not very focused, not very stable, not very direct and definitive. So what are we going to learn from this? Trade management, be definitive, and make sure that you always protect your capital for the future trading, for your future trades. Do not focus so much on that trade that you're in, because once you're in, it's in the past. This trade is either going to help your account or hurt your account. This trade is either going to help you mentally, help your confidence, or hurt it. And more importantly, always understand that you want to trade for the future. You want to place future trades. And the only way traders stay in business is to have an account. Hope this helped, and I'll talk to you soon.